At about $4 million, adding more money can make you feel richer, without making you much safer. Your retirement screen keeps climbing, but one ugly drop can still punch a hole in your future income, if too much rests on one idea. That sounds backward. More money should mean more security, right? What's interesting, past a point, the game changes. It stops being about growing the pile. It becomes about making sure no single mistake can wreck it. Your kitchen stool wobbles the second you sit down. One leg takes all your weight. You reach for the table, miss, and the coin jar rattles onto the floor. That little crash is the whole problem. A stool does not become safe because the wood is expensive. It becomes safe because the weight is spread out. 4 legs, 4 points touching the ground. If one leg gets weak, the whole thing might creak, but it usually does not throw you across the room. Now flip that over to your money. You can have a huge account and still sit on a one-leg stool. This happens if too much depends on one thing, one company, one sector, one rental, one hot fund your coworker swears by. The dollar amount can look impressive. The structure can still be fragile. That is why more money eventually stops solving the real problem. Early on, the goal is simple. Grow the pile. But later, the bigger question changes. If one piece gets hit, does your whole plan tip over with it? That is what people mean by diversification. Spreading your money across many things so one loss can't sink you. Not fancy finance, just this. Don't let one leg hold up the whole chair. And notice what makes this tricky. A single strong leg can feel amazing for a while. It may even look better than 4 ordinary legs. Your statement goes up faster. You feel smart. You start trusting that one leg more and more. Then life does what life does. A bad earnings report, a rule change, a lawsuit headline at 8:14 a.m. Suddenly the thing carrying everything is the exact thing giving way. The first payoff is simple. Safety is not about building the tallest pile. It is about building a pile that can take a hit. If this reframe helps, subscribe. 2 of these a week. The pattern is clear. Most beginners miss the next part. Once your account gets big enough, the job is not really grow it faster anymore. The job becomes something else entirely. So what should matter more than the total balance on the screen? Friday morning. Rent clears, your paycheck lands, and you start splitting money into jars. One jar is for bills, one is for emergencies, one is for retirement, and one is for income later, when work stops. That last jar is the one most people misunderstand. When your account is small, the screen balance feels like everything. You check it, it jumps, it drops, your mood follows. But once the pile gets serious, the better question changes. Not, how fast is it growing? How many different ways can it keep paying you? That is what diversification, spreading your money across many sources so no single one can sink you, looks like in real life. Not some fancy spreadsheet. Not owning random stuff just to say you're spread out. It means your future does not depend on one paycheck, one company, one fund, one sector, or one lucky streak. Picture retirement like 4 simple taps feeding one sink. Maybe one tap is stock dividends, regular payouts companies send to shareholders. One is bond interest, money you earn for lending to a company or government. One is cash set aside for near-term spending. One is delayed income like Social Security. If one tap slows down for a year, you still have water. Now compare that to one giant tap. It looks powerful, until it sputters. That is why income matters more than the headline number. A huge balance can still be fragile if too much of your future depends on one source. A smaller balance can feel safer when the cash arrives from several places, on several schedules. So the real test is not, how much do you have? It's if one part drops 30%, does your life change next month? Because 2 people can have the same account size, and only one of them is actually sleeping well. So why do 2 people with the exact same $4 million retire in totally different moods? Put 2 plans on a whiteboard. Left side, 1 giant tower. Right side, 4 shorter pillars. Same total height, same dollars. Very different safety. On the left, your whole future leans on one thing. Maybe one company stock, maybe one rental building, maybe one business sale sitting in one account. It looks powerful because the number is big, but big is not the same as stable. If that one pillar cracks, the whole roof shifts. Now look at the right side. 4 pillars, none of them heroic. Together, they carry the same weight. One could be Social Security, one could be bond interest, one could be stock fund dividends, a slice of company profits paid to you, one could be rent from a property. Different sources, different timing, different ways of failing. That difference matters more than most people think. Say both people need $12,000 a month to live well. Person A gets $10,000 from one source and $2,000 from somewhere else. Person B gets $3,000, $3,000, $3,000, and $3,000 from 4 separate sources. Then a bad year hits. One source drops 30%. For person A, that monthly cash falls from $12,000 to $9,000 almost overnight. That is not a paper loss. That is canceled trips, delayed repairs, and studying the grocery total. For person B, one of the four streams drops 30%. Monthly cash falls from $12,000 to $11,100. Still annoying, still real, but life probably keeps moving. Same wealth, different fragility. Here's why it works. Beginners miss this. You do not feel risk only when a chart crashes. You feel it when one weak spot can reach into next month's bills. A giant pile of money can still be fragile if too much of it depends on one outcome. A smaller pile can feel stronger when the pressure is shared. It is the same reason you would trust a bridge with several support beams more than one massive column. Strength is not just size. Strength is how many ways the structure can survive damage. And retirement works the same way. The goal is not to build the tallest tower. The goal is to make sure one bad hit cannot decide your whole life. Which leads to the uncomfortable question. What happens when that big single holding actually drops hard on a real statement? It's the same edge a poker player has at the table. The discipline to fold a tempting hand when the numbers turn, and the nerve not to tilt after one bad beat. Monday night. You open your retirement statement after dinner. The microwave is still beeping and your stomach drops. The account says $4.2 million. That sounds untouchable. Then your eyes land on one line. $2.5 million in a single company. The rest is scattered around. Some index funds, some bonds, some cash. But that one line is the engine. Now pretend that company gets hit. Not bankrupt, not a fraud, just a nasty reset. A weak earnings report. A new competitor. Guidance cut. The stock falls 40% over 6 months. Your account doesn't lose 40%, but it does lose $1 million. And that's the part people miss. The danger was never your total number. The danger was how much of your future leaned on one thing behaving. On paper, you're still rich. You still have $3.2 million. Friends would say, you'll be fine. But retirement is not a bragging contest. It's a paycheck problem. Say you plan to pull 4% a year. $4.2 million could support about $168,000 before taxes. After that drop, $3.2 million supports about $128,000. Same person, same life, same grocery store, same property tax bill. But now there's a $40,000 hole in the annual income plan. That hole shows up fast. Maybe that was the travel budget. Maybe it was helping your mom with rent. Maybe it was the cushion for medical bills later. Overnight, one red slice on a pie chart turns into a real-life subtraction. This is the retirement stress test. Not can the account grow. The better question is, if one part gets punched, does your whole life have to change? Run the check piece by piece. First, if your biggest holding fell hard, would your monthly plan still work? If the answer is no, the account is fragile. Second, is too much of the account doing the same job? A lot of people think they own 10 different things, but if 8 of them all rise and fall together, that's not 10 supports, that's one support wearing 10 costumes. Third, if you had to replace the lost income tomorrow, where would it come from? If the honest answer is, I guess I just wait for it to come back, that's not a plan. That's hope dressed up as patience. And hope feels fine in bull markets, times when prices keep rising. Everything looks sturdy when nothing is shaking. The pattern is clear. Bigger accounts can hide this weakness better. A $200,000 account concentrated in one thing looks risky. A $4 million account concentrated in one thing looks sophisticated. Same structural problem, fancier packaging. Poker players get this without spreadsheets. If one bad hand can wipe out your whole night, your money was in the wrong place before the cards even came out. The trade was lost earlier, when too much sat on one outcome. Retirement works the same way. One drop should sting. It should never get to rewrite your lifestyle. So if the real goal isn't more, but harder to damage, the next question is simple. What would a truly shock-proof account need to look like? Here's the shift. Past a certain point, more money matters less than fewer ways to get hurt. A table gets sturdy when the weight stops leaning on one leg. Your retirement works the same way. What if one company can crack the whole plan, or one sector, one rental, or one paycheck-like stream? Then you're not rich in the way that counts. You're exposed. How much of your money is at risk in one spot, in one fragile place? So give this a name. The 4-leg portfolio rule. Quick aside, if this helps, subscribe for more twice a week. Before you call an account enough, check 4 things. First, no single holding should be able to slash your lifestyle by itself. Second, your income should come from at least 4 different sources. That way, one bad year doesn't choke everything at once. Third, you need cash or near cash for surprises. Then you're not forced to react at the worst moment. Fourth, each leg should behave differently when the economy changes. If all 4 fall together, that's one leg wearing 4 costumes. That's the real upgrade. Not bigger, harder to damage. And this is why a smaller account with balance can be safer than a larger one with a single giant weak point. But there's one mistake people make right after hearing this. It quietly rebuilds the same risk all over again. Next payday, do one boring thing. List your top 4 holdings, the 4 investments you own the most of. Then ask, what happens if one drops 40%? If the answer is, my whole plan changes, you're still standing on one weak leg. That's a warning sign. Want more rules like this every Tuesday and Thursday? Subscribe. The next breakdown covers the sneakiest concentration trap of all. It's 4 different names that still rise and fall together.